It's time now for Mortgage Matters with your host, Bill Sandvig. Bill Sandvig serves as market leader, running the South Carolina coast for Movement Mortgage. Movement finished 2014 ranked as the #1 mortgage company in purchase mortgages for the Charleston Tri-County area. And they're still growing. And now your host of Mortgage Matters, Bill Sandvig.
Good morning, Charleston. I'm Bill Sandvig, and this is Mortgage Matters. I got a really good show for you today. We're going to talk a little bit about building credit. And if you're out there listening and you've got older children or kids getting out of college, we're going to talk about how to establish credit for your kids so you can set them off on the right track. I'll say my father was in the mortgage industry, and I graduated high school and went on to college, and he never sat down and talked to me about credit. I'm going to admit that when I was a young adult and I was staring at my bills, making a moderate income, and I had a DirecTV bill to pay, or I had a credit card bill to pay, I knew my DirecTV was going to get shut off if I didn't pay that. But if I didn't pay my credit card bill, I could just catch up when I had a little bit extra cash in 2 months. Well, I wish my father had said that would be the wrong thing to do. And there's probably a lot of kids out there that don't get that conversation. They don't have that talk. So I want to talk to you a little bit about later in the show about how to train your kids, how to set them up on the right path for building credit. Then we're also going to talk about how to help your kids buy a home and the conversation you can have there. There are a lot of parents that show up as co-signers on loans, helping with down payment, lots of things, lots of questions that come up with that. So we're going to talk about that in later segments. First thing I want to talk about is you heard the company I work for, Movement Mortgage. I want to talk about who they are, who Movement Mortgage is. You might not have heard us. This might be the first time you're hearing that company name, Movement Mortgage. Well, I'll tell you, here in the Tri-County area, we've been in the market for about 18 months now. Last year was our first year in the marketplace. We finished 5th in purchase mortgage share. 5th place in purchase mortgage share last year. Out of all the banks and all the lenders you can go with, there are hundreds, literally hundreds, and we're proud to say in our first year in the marketplace, we finished 5th. We were also the #1 non-bank depository lender in purchase mortgage share. And Movement Mortgage is a nationwide company. We can do mortgages all across the country. But it always wasn't that way. Just founded in 2008 with 10 people in a small room. The company has been the fastest growing mortgage company in the country since 2008. No other parallels, no other competition stands hold for the growth that we've had. The reason we've had such growth is because of our direct, dedicated commitment to our real estate partners, to our clients. The service that we provide, the service level is unmatched. I'm proud to say there is nobody that holds a candle to us. I might be biased, but I've worked for a number of different companies. The people that work with me and work for me, they've worked for countless different companies, and they all say the same thing. This is the best place that they've ever worked for in the mortgage industry, and we're proud to call Movement Mortgage home. Movement Mortgage is also a local company. We just broke ground on a brand new national headquarters here in the state of South Carolina. We are going to be moving a $24 million facility, building it from the ground up. It's going to be here right in South Carolina, located up near Rock Hill, and we are excited. Governor Haley was with us just a couple weeks ago at our groundbreaking ceremony. The building's going to be up in the first quarter of 2016, and we are immediately going to be moving 700 jobs to the low country, to the state of South Carolina, with expectations for over 2,000 new jobs in the state in the next 5 years. That is something that I'm very proud of, something that we can hang on our, put a sign out, say, look, we are a local company. We're here, and this is our home. This is our home field. This is our turf. So if you call me, you're calling and supporting a local business. And if you do want to call me, please call during the show. You can call. We're live here today, so you can call in with any questions you might have about mortgages, about finance, about lending, about guidelines, credit. Please call in. 843-556-1250. And if you have a question for me anytime, you can reach me at 843-300-7870. That's my cell phone. If you don't want to call into the show, shoot me a text. I got my phone right here. I can answer questions over a text and address it right here on the air so other people can hear your questions. And so that's a little bit about who we are. If you want to reach me at my website, www.lowcountrylending.com, I am happy to talk to you. You can find me, look me up, shoot me an email. So talked a little bit about who Movement is. I want to talk a little bit about me, how I've gotten to be a mortgage lender, how I got into the industry. I grew up in the Northeast, but I've been down here in the South for over 10 years now. And when I left home, joined the service, went to the Naval Academy in Annapolis, and 4 years later, I found myself as a submarine officer doing nuclear engineering, serving in the Southeast in Georgia on the USS Maryland. So I served for 8 years. I have a lot of experience with military, doing VA loans, doing military loans, a lot of knowledge there. I don't shy away from helping out our veterans. My peers are there. After serving in the submarine force, my last duty station was here in Charleston, and man, did I fall in love. Moved here in the end of 2005, and served in the Naval Weapons Station up in North Charleston. And there's 2 submarines up there, and fell in love with Charleston. And I said, I'm not going to leave. So ended up getting into the mortgage industry, and I've never looked back. It was a great move after getting out of the service. Love the industry, love the people that I get to work with, love the real estate agent partners that I get to deal with daily, and I love solving problems for my clients. I love it when I can talk to someone, address a situation, help them work through and attain their goals. It's a sense of accomplishment that I enjoy every day. So that's just a little bit about me. So during this segment, I want to bring up and address some new changes that have come out just in the last week with FHA, Federal Housing Authority, lending guidelines. They've made some changes, and they're coming up. They're going to be effective on June 15th, and it's going to become a little bit harder for new home buyers to qualify for a loan. And if you've gone and gotten a pre-approval letter, that amount that you've been told you can buy, that you can purchase, very well may be going down because of some of these changes that the FHA has put out. I think this ties in well with first-time home buyers, with your children. If you're out there listening, you know someone who is about to buy a home, thinking about buying a home, on the fence about buying a home. I want you to listen to these next couple changes. I want you to make the phone call and have them reach out to me, 843-300-7870, so that I can talk to them about some of these changes, because it might be the difference for some people between being able to buy a $200,000 house, and on June 15th, that $200,000 might become $160,000. It might be the difference between qualifying and not qualifying for a home purchase at all. So the very first change I want to talk about has to do with student loan debt. With FHA loans, first-time homebuyer FHA loans, right now, we are able to exclude student loan debt from liabilities as long as they're not in repayment. So a lot of people know that you can defer your student loan payments. They can even be requested to be extended out a couple of years. And when that happens, right now, we do not have to count that debt against you in your qualifying ratios. On June 15th, that's going to change. There will be a payment included, no matter how far off that payment is, no matter how far off those student loan debt payments start, they're going to be counted against you. The next question people ask is, well, what about if my parents are paying that bill? What if they're the ones paying the student loan bill? That doesn't matter anymore. You're going to have that debt count against you when you're qualifying for a mortgage. And for some people that have gone through college, and maybe you went to grad school and you've got a good amount of student loan debt out there, or maybe you're a teacher and you went through college and you built up student loans, and you know that those student loans are going to be deferred for a while, and then they're going to be forgiven. There are a lot of programs that allow for that. There's still going to have to be a student loan debt accounted for when you're trying to buy a house. This will impact people you know. It will impact people in the amount of home that they can purchase. So I'm urging you to take the time to make a phone call and talk to a real estate agent, talk to a lender, and learn what your opportunity is right now. If you're on the fence, if you're thinking, oh, July is the time, the end of the summer is the time, I'm going to wait, don't wait. Because if you get under contract and we can order and we can request a number from the FHA that locks in your rules prior to the June 15th, you can close after June 15th. We just have to start the process before June 15th. If we don't start the process, you will then be exposed to the new rules, and you might be buying less house than you think you're qualified for right now. So I urge you to reach out. Again, if you have any questions, please call into the studio. I'm happy to talk to you. 843-556-1250. And so we talked about student loans. The next one has to do with income. If right now, if you're working part-time, as long as you've been working part-time consecutively for 12 months, we can count that income. On June 15th, that's going to change. It's going to be a 2-year requirement, 24-month history of part-time income for that part-time income to count as qualifying income for a purchase. If there is a gap of employment, which means you take some time off, you work part-time during the school year and then you take time off during the summer, the income won't count. If you go on maternity leave, I have had that question this week, the income won't count. The part-time income won't count unless there's continuity of employment for 2 years, 24 months. There's also, if you're job hopping, if you've taken a couple different part-time jobs, you can only have had 3 different jobs with no gaps over the last 24 months. If you've had more than 3 part-time jobs or a gap, the income that you're earning from that part-time job will not count. Now, let's think of a situation where this would really apply. Maybe you have one person in the family that's working full-time. The other person's working part-time and spending the rest of their time taking care of the household and taking care of the children. Well, if that person who has the part-time income is not working straight through the last 2 years, we're going to have to ignore that income completely and qualify you only off of the income of the primary earner. That's a huge difference when first-time home buyers are trying to qualify for a home. It can make a huge difference in your buying power. So we talked a little bit about student loans. We've talked about the difference of part-time income. The next one has to do with down payment. One of the big advantages of doing a government loan is that the down payment can come from a family member. The gift, it's called a gift. And the entire down payment, all of the closing fees, everything can be covered by a gift. So the home buyer doesn't have to have any savings. In the past, we have not had to document where that gift comes from. As long as the money is available, they sign a gift letter, the money can be transferred directly to the closing. We don't necessarily care where that money came from for the gift. So, whereas if it's your own money that you're putting down, we have to source and document all the funds that are going to be made available for closing. Well, now we're going to have to document the gift money that's coming from parents or from family members for a down payment. This means that right now, parents don't have to provide bank statements. They don't have to show the money being available. A lot of parents don't like the idea of sending in bank statements and trying to explain where the money came from and documenting all these transfers. Well, and June 15th, that's going to change. On June 15th, you will have to provide a bank statement that shows the money available. And if you moved money into that account, we're going to have to explain and document where it came from. So here's a scenario. You move $50,000 from a retirement account or from an investment account, put it into your checking account to give a gift for a down payment for your children. We are going to have to not only see the statement where the money is now, we're going to also have to see the statement where the money came from. So we have to fully document these funds. So those are 3 changes that are really going to impact the entire lending scene. And what I want to urge you, because of these changes, is to reach out now. Talk to someone now. Talk to an agent now. Talk to a lender now. If you have any questions for me, please reach out to me directly at 843-300-7870. You can also find me at my website, www.lowcountrylending.com. This is Bill Sandvig and Mortgage Matters. We're here on 1250 WTMA, the Big Talker, and we'll be right back.
There's more Mortgage Matters with Bill Sandvig coming up next on the Big Talker, 1250 WTMA. WTMA. You're listening to Mortgage Matters on 1250 WTMA. Once again, here's Movement Mortgage's Bill Sandvig.
We just spent the first segment talking about some real big changes that the Federal Housing Authority has come out with last week. They're going to really impact lending guidelines, really impact first-time home buyers' ability to buy a home. It's pretty interesting that they've tightened things down a little bit this last week when all the news that you hear is about slowly loosening guidelines and letting more people to get into homes. But here they are tightening things down, which is the opposite direction of what everybody is talking about in the news, what the administration is talking about in the news. And what I want you to do, I don't want to rehash all the things we talked about in the first segment, but what I want you to take away is the changes are coming June 15th. They will impact your ability to qualify for a mortgage and how much you can qualify for. And now they're not going to apply to necessarily everybody, but you have a family member or a friend, somebody who is about to make that home purchase, and they are going to qualify, or they very well could qualify for less house, or maybe even not qualify at all because of the changes that are coming June 16th. Now, I want to spend this segment talking about a topic that's near and dear to my heart, and that's credit. And I want to talk about your kids' credit. And maybe you're a young adult out there, or you've got children or grandchildren who are about to become of age where they're an adult and it's time for them to start going out on their own. A conversation that should be had that's so important is how to handle and manage money and how to manage credit. And most people don't know how to do it. I'll tell you, building credit is relatively easy, and it can be controlled and it can be planned for. And going out there, you don't have to make a whole lot of money to be able to qualify and buy a house. You just have to plan ahead. So reach out to a professional like me anytime, 843-300-7870. That's my cell phone. You can find me on my website, www.lowcountrylending.com. Please reach out. I'll be happy to talk through some of this stuff with you, answer any questions you have. I am live here in the studio on 1250 WTMA, the Big Talker. And if you have any questions, call in 843-556-1250. 843-556-1250. Let's talk about mortgages. But right now, we're going to talk about specifically building kids' credit. So when your child turns 18, I'll tell you what I'm going to be doing with my daughter when she turns 18. It's coming up this year. And her birthday present is going to be a trip to the bank with Dad. Because we're going to go to the bank and we are going to get her a car loan. And we're going to get her a credit card. And we're going to get her a second credit card. Now, maybe it might need to be what's called a secured card, where we have to put a little bit of cash out to establish that credit line. But I'm going to get her 2 credit cards and a car loan. That's not going to be a big car loan. It's going to be small. A couple $1,000 stretched out over 4 years with a nice little tiny $40 or $50 payment. When we do that, she's going to establish on her 18th birthday 3 credit lines. 3 credit lines is the magic number when you're qualifying for a mortgage to tip you up into that top tier. When you have 3 credit lines that have been established for 12 months, when you have 3 credit lines established for 12 months, that is going to build your credit in a positive manner super fast. By the time she's 19, she will have a credit score in the mid 700s. We got a phone call. It looks like John and Ladson.
John.
Hey, John, how are you doing today?
Okay, how are you doing?
Doing great.
Good. My question is, a number of years ago, 6 or 7 years ago, I had a business fail, and as part of the fallout from that, I ended up with about a $20,000 judgment against me from a credit card company.
Mm-hmm.
My credit score has returned. I'm mid-700s now, and income is good. But my concern is that if I purchase a home now, that title becomes subject to that judgment at some point, and I didn't know if there was a way to protect the home from that judgment.
Sure. So there's a possibility but it's going to take action from whoever put that judgment against you. They're going to actually have to transfer that judgment, reactivate it, and place it as a lien against your new piece of property. From a qualifying standpoint, eventually that judgment will go away. And to get around that judgment, we can actually establish a repayment plan with the creditor that you can start to make a small or moderate payment on that, which we can include in your debt to income ratios and allow for you to buy a house. So it's definitely not something that's going to keep you from buying a house at all. And I mean, I would suggest not letting it get in the way of buying a house, because the benefits of home ownership are going to severely outweigh the need to pay back that debt. does that answer your question? It is important to note that it's going to take an extra step from that person to actually refile that judgment, which they most likely are not going to do, to connect it to that new property.
Well, if they're monitoring that, if they're still monitoring my credit, which I believe they are, because I see a reporting on my credit on a regular basis for the judgment.
Mm-hmm.
My concern is that when I got a mortgage, they're going to see I have a mortgage, and then come after me. What's happened over the years is one of these attorneys firms that really don't practice law. They just go around and buy judgments for pennies on the dollar. I think that's what it is, and so that's what they do for a living. So I believe that they would reactivate, or whatever the terminology is, and then put a lien against the title, and therefore tie up the title or any equity in the home until they got theirs, which is substantially worse now because of the 12.5% that they charge for interest. I mean, I'd happily stroke up a check for some reasonable amount. There was a settlement.
You'd probably, I'd be happy to talk more about it when I'm off the air, and I do have your number, so I'll reach out. But you'd probably be surprised at how low they'd be willing to settle for if you were to work out a payment plan. And the money there is going to, in the long term, it's not going to really come to fruition until you go ahead and, if they do refile a lien, until you try and sell the house. So, and comparing, renting for the remainder of your lifetime compared to owning and building equity, the equity and the value of that home ownership is going to way outweigh trying to avoid that judgment. Thank you so much, John, for coming on the air. I appreciate it.
Thank you.
So I want to get back to this conversation about building your credit for your children. I talked what I'm going to do with my daughter when she turns 18. The first thing is establishing credit. When you have good credit is the most important thing. Well, bad credit, believe it or not, can actually be better than no credit. If you have no credit, you can't get a loan. If you have bad credit, I can fix that and get you into a loan. So it's not good credit, no credit, bad credit. It's good credit, bad credit, no credit. So the first thing you want to do for your kids is sit down and talk to them. And on that 18th birthday, when they're eligible, go and get them a credit card. Go and get them two credit cards. And then what you want to do is you want to coach that child. You have these two credit cards. Obviously, you don't want to run them up past the limit every month or be paying minimum payment. What you want to do is these cards are going to go into your wallet, and you're going to use them each once a month. You're going to charge 1 tank of gas to this credit card, and then 2 days later, you're going to pay it down. And then the next time you need gas, you're going to use the other card. You're going to charge that tank of gas, and you're going to pay it down. We're going to get you a small car payment. And maybe, parent, you want to be the one that pays it. That's fine. You can be the one that pays it. But we want them to have that liability because it's going to build their credit. If they just get two credit cards and don't use them, that's the credit agencies are going to look at that as like, sure, there's available credit there. That's great. But they're not using it. What they want to see, what they want to see is that you're managing credit, that you have credit and you're managing it and you're managing it wisely. That's what builds a credit score. So go use the two credit cards, get that car loan, make payments. Maybe it's not a car loan. It could be any kind of personal loan, anything that's going to have a repetitive monthly payment. By the time that child is 19 years old, they're going to have a 12-month history on 3 cards. They're going to have strong credit and be headed down their way to being able to become a homeowner and get the very best interest rate, get the very best payments, get the very best opportunity for different loan products. When they do go eventually buy another car, they're going to be eligible for those 0% interest rates. They're going to be eligible to keep their costs down. You're setting them up for success. If anybody has any questions about this stuff, I can go into real strong detail. I can coach you through this. And maybe it's not for a child. Maybe it's for you. Maybe you've never gone out there and established credit before. Maybe you haven't done this. I can coach you through it. I can coach you to do it wisely and do it smartly so you can be in position to buy a house. I'll tell you, if you've never had any credit before, you're going to have a hard time going and buying that mortgage. This is not my rules. These are Fannie Mae and Freddie Mac's rules. They're the ones that set the rules here for getting a mortgage, and they've got to see those 3 trade lines, 3 active trade lines, and you can control that. You can control that on your kid's 18th birthday. You can start the process towards building them excellent credit. In the next segment, I'm going to talk more about helping your child. Now that you've established their credit and you've helped build their credit up, we're going to talk about how to buy a house with them and some smart things to do about when they're buying that house. Please call in 843-556-1250. I'm Bill Sandvig. This is Mortgage Matters here on 1250 WTMA, the Big Talker. We'll be right back.
Bill Sandvig has more Mortgage Matters straight ahead on 1250 WTMA, the Big Talker. WTMA. This is Mortgage Matters on 1250 WTMA. From Movement Mortgage, here's Bill Sandvig.
All right, we just spent the last segment talking about how to build credit and how to help your children build credit fast. When they turn 18, you want to go and establish credit, get them an installment loan, like a car loan. It could be small. Maybe they have a car that a startup car that you paid cash for, or something along those lines. Well, if you do have a car that you paid for and they're driving that car around, take that car in, go to the bank, get a small loan, stretch it out over a couple years, and it'll have a small little tiny car payment. I mean, $50 a month, $60 a month. Get 2 credit cards, small little limits. Don't build the limit up. Just use it once a month, pay it down. It's going to build your kid's credit up super fast. By the time they're 19, they're going to be in position to they could be in a position to go out and buy a house because their credit is going to be so strong. And the payments that they would have on a tiny little car loan and 2 little credit cards that don't have a very high balance, maybe minimum payments, they're going to have liabilities of less than $100 between those 2 things. And they could actually go and buy a house when they get out of college. I want to crunch some numbers. We're going to talk this segment about what you can do as a parent to help your children make that first home purchase and when the right time to do that is, how you want to be involved. The first thing that when someone has credit issues is they ask, well, can I find a cosigner? And that seems to be the first solution is, well, what if my parents cosign on the loan? Can we buy then? Well, a common misconception is cosigners cannot fix weak credit. If your child has a weak credit score, your 800 score is not going to let them get a better interest rate. It's not even going to help them qualify. If they don't qualify because of their credit, your good credit is not going to counteract that. That works with car loans, but it doesn't work with houses. Housing rates depend on whoever the lowest credit score is of anyone on the loan. What you can help with is income. So if they're falling short in qualifying income compared to the eventual mortgage payment, you can go onto the loan and use some of your income to help boost up the overall qualifying ratios and help them purchase a higher priced home. That you can help with. Now, what's the big drawback? The big drawback is when you tie yourself to that loan as a cosigner, you are going to be responsible for that payment. Should the child not make the payment on time, your credit is going to get hit with a mortgage late, something you don't want. If you want to go buy another house, that payment for the other loan that you co-signed is going to count against your qualifying ratios. And so you might not be able to afford the house that you're looking to move into in a future date. So that has to be weighed in. It's a real serious repercussions when you're talking about co-signing on a mortgage with a child. I personally think that it's better and it's smarter to do a gift. If you have that ability and you can give a gift and help that your child lower the total payment to help them qualify for the house, that's a smarter way to go. Not everybody has that opportunity to be able to just give money to be able to help pay down the mortgage balance, help keep the payment into a qualifying levels with the income the child has. But I believe that's a better option than co-signing. There's lots of repercussions that come along with co-signing. I can talk through them all with you. Please, if you have any questions about this stuff, call into the studio. We're live, 843-556-1250. You can call me, Bill Sandvig, anytime, 843-300-7870. Shoot me a text right now. I'll address a question right now on the air. And you can find me at my website, www.lowcountrylending.com. Now, so co-signing, gifts for down payment, that's all great stuff. But here's what I think is one of the coolest things for first-time home buyers, for young adults who are getting into the real estate market, and that's buying multi-unit properties. I talked about how to establish your kid's credit and what I'm going to do with my daughter. And we're going to go out and get her those 2 credit cards, get her that small car loan, and she's going to have about $100 a month of debt that she's responsible for. Well, if you have only $100 a month of debt and you're earning $30,000 a year, so she gets out of college, she's been making payments on these 3 installments, for the last couple of years. She goes out and finds a starter job, and she's making $30,000 a year. That $30,000 a year, with only 5% down on a conventional loan, she would be able to qualify for a $180,000 home purchase. My newly graduated, or your newly graduated from college child, because you've established good credit, only making $30,000 a year, can qualify for a $180,000 home. What? Yes, $180,000 with today's rates. That is a lot of house for a 22-year-old. Imagine starting your kids off on the path for financial success and financial freedom by them being able to move right into a home, start building equity in a house, stop paying rent, and have that kind of impact for their future and for your grandchildren. Now, let's take it a step further. If they were to buy a multi-unit home, a lot of people think, I want that residual income. I want to buy some investment properties when the time in my life is right down the line so I can have some residual income, build towards retirement, build equity in houses. It's a great thing to do. A lot of people have it on their to-do list, and people plan, and it just never happens. It never comes. The timing is never right. Life gets in the way, and they just never come around to it. Well, I'm here to say that the best time to do it is right when you're getting started. Right now, I talked about part-time income. If you have part-time income for the last 2 years, I'm going to talk about an extreme situation. I'm going to keep going back to my daughter. My daughter has been working part-time. She's a senior in high school, and she's been working part-time for the last year, over a year now, and she earns about, $700 to $800 a month with a part-time job while she's finishing high school. If she was to keep that for the next year, by the time she turns 19, and if she keeps that for the next year, and when she still has that $700 a month coming in, she would be eligible for going to buy a multi-unit home. She could actually, if the situation was right, qualify with just her on the loan because we built her credit and she only earning $700 a month. She could qualify for up to a $400,000 purchase if the situation was right. Now, what does that mean? You're like, wait, how does this 19-year-old girl with $700 a month of income qualify for a $400,000 mortgage? Here's how. If she was to move into one of these 4 units in this multi-unit, 4-unit property, a quadplex, it's a $400,000 quadplex. If she was to move into one of those units, and hypothetically, the other 3 units are each renting for $1,200 a month. There are properties out there right now that fall in this situation. She rents out the other 3 units for $1,200 a month. We can count that projected rent against the payment for her mortgage. The mortgage payment, with only 5% down on a $400,000 purchase price, including taxes, insurance, mortgage insurance, including everything, would be around $2,400 a month. She's going to receive potentially $3,600 a month in rental income for those other 3 units. We're allowed to count that as income. There's a couple of factors that weigh into it, but when it all breaks down, her qualifying payment on this purchase mortgage is effectively zero. So because I built her credit up, because she has a part-time job making $700 a month for 2 years, she could buy a multi-unit $400,000 mortgage with no problem. Now, that's an extreme situation, obviously. My 19-year-old daughter is going to go move into a 4-unit home and become a landlord. But there are your children, your grandchildren, family, friends, you, a first-time home buyer that thinks they're years off from being able to build 3 or 4 rental properties, could, as a young adult, with putting almost no money down, be living for free, no payment basically, because the other properties are paying your rental payment. And when it's time for you to move on, you keep the house. You got another. Now you got 4 units paying rent for a mortgage, and you move on to buy your next house, and all of a sudden you've got 4 rental properties, and man, does the future look bright. I mean, it's really, really powerful stuff. Really powerful stuff. And it all comes back to planning ahead. You got to plan ahead on this stuff. You got to talk to the right person. You got to talk to someone local. Call me, 843-300-7870, because if you talk to someone local, I promise I can help you. If I don't know the answer to the question, then I can put you in touch with someone who does. I know plenty of local professionals who are here to serve you that do excellent customer service. I've vetted them for you. I got a couple partners like Jimmy Fody, who was on the show with me last week, a prominent real estate attorney. You can reach him anytime at www.fodylawfirm.com. And he's happy to address any questions, free of charge. He's happy to help. Another partner who's also been on the show with me many times, Andrew Muller of Mappus Insurance, owner and president. If you need help with property and casualty, flood insurance, there's been some huge changes that have come up in flood insurance. He's there. He's there to talk to you and coach you through this stuff. I've got plenty of people that I can refer you out to. Please give me a call anytime, 843-300-7870. I'd be happy to talk to you about mortgages, about anything else. It's really powerful stuff, what we just talked about. The ability for, to be earning very little, just plan ahead, and to be building towards your future, making home purchases, using real estate to your advantage. It's very, very powerful stuff. We're going to talk a little bit more about how to put yourself in position to make an offer that matters in a very hot market, in a purchase, in a seller's market, how to separate yourself and how to make yourself look good when you're going to buy a house. And please call in 843-556-1250. This is Bill Sandvig and Mortgage Matters. We're here on 1250 WTMA, the Big Talker.
Mortgage Matters continues next on Charleston's Big Talker, WTMA. Now, let's get back to Mortgage Matters on the Big Talker. From Movement Mortgage, here's Bill Sandvig.
I'm Bill Sandvig. This is Mortgage Matters. Please call in with your questions. We're talking about mortgages, finance, money, investment properties, real estate. Please call in 843-556-1250. We spent the most of the show talking about how to build credit, how to establish credit for your kids, and how to properly position yourself if maybe your child needs some help making that first mortgage purchase. And I want to stress from those last segments that it's really all about planning ahead. When you plan ahead and you talk to a professional that knows what they're doing, we can pretty much pull off anything. I mean, there is so much opportunity out there. There are so many different ways to break into the real estate market, break into the investment game, break into being a homeowner. All it takes is planning ahead. And I can lay out a path that's going to make perfect sense for you, make perfect sense for your kids. And one of the most awesome things I have going on right now, I talk to it about, I think that's going on is I talk about with every single customer that calls me, I talk about the opportunity of moving into a multi-unit property and having those other units pay for yourself, and you can have a really, really moderate income and qualify for some really, really cool stuff, and not only have your housing and your living expenses paid for, but also be building equity in a property that's way more valuable than you ever imagined. And then once you maybe want to move on from that property, that multi-unit house, 5 years down the line, a couple years down the line, all of a sudden you're moving into a new primary residence and you're leaving behind 2, 3, 4 rental properties that you've been not even paying for living in for the last couple of years. Really cool stuff. Now, what I want to talk about is this last segment, and I talk about it almost every show. It's about leverage. It's about if you're out there thinking about buying a house and you're buying right now in what is an exceptionally strong seller's market, where multiple offers are happening all the time, how do you make yourself stand out so that you can be sure that you get the house you want, that first house you see that you fall in love with, that your family falls in love with? How do you get that house, and how do you get it at the best price? If you're thinking about buying, one of the first things you should do is reach out to a real estate agent. If you don't have a real estate agent, you should have one. Everybody in the entire country should say, yes, I have a real estate agent in my phone. If you don't have one, call me, 843-300-7870. I will get you one who specializes in your area and specializes in the type of properties you're trying to purchase. And so the first thing is you should have a realtor. If you do, that realtor probably at some point has said to you, are you pre-qualified? are you pre-qualified to go out and buy this house? Because when we go out and look at this house, I want to be able to make an offer. The market's hot. We got to be in a position to move quick when we find the house that you fall in love with. Well, I'm here to say that getting pre-qualified is the wrong thing to do. It's not enough. Getting pre-qualified, you'll get a pre-qualification letter from a lender out there, and it's going to, somewhere on that letter, it's going to say, this is not approval for a loan. This pre-qualification letter is not approval for a loan. The reason is because loan originators and people who you've initially talked to start the process are not qualified to issue approval on a mortgage. That takes an underwriter. Movement Mortgage, my company, has dedicated extra time, extra man hours, extra money, so that you, the buyer, who doesn't even have a house yet, we can take a full application, send you into the underwriting center, send you into the processing center, and issue a decision on your ability to buy a house. We are going to take you, not just pre-qualify you, but we're going to get you fully approved. We do it, we get you fully approved, and we do it fast. The expectation is in 6 business hours from the time that you provide us all the documentation and we send that file into the underwriting department, 6 business hours later, a decision is rendered and you are approved for a mortgage. That means by the time you're out there on the weekend looking at the houses, instead of just having a pre-qualification letter, you're going to have a commitment letter, a commitment to lend on you for the mortgage amount that you need for buying that house. Now let's think about the impact that has. Let's think about the leverage that creates. What we are doing is taking someone who needs a mortgage and is pre-qualified, and we're making you look like a sure thing. We're making you look like a positive guaranteed bet. We're making you look like cash. When someone's buying with cash, and let's say you're selling a house, and it's a hot market, right? We know the multiple offers are all over the place. There are countless houses being sold before they even hit the market with multiple offers. Day one, it's a good deal. All of a sudden, there's 6 offers. Day one. How are you going to get that good deal and separate yourself from those other offers? It's to make your offer, well, one is obviously offer more money. Well, that's not all that matters. Sellers don't want to risk having their house go into escrow for 45 days, 60 days, then get dragged out while they wonder if the person who said they're going to buy their house can definitely buy it and get approved for that loan. The pre-qualification letter, which says this is not approval for a loan, is not enough. Too many deals fall through. You've heard horror stories out there. I sold my house, the loan fell through. I sold my house again, the loan fell through. By this time, I had already purchased the next house, and I had to sell this house before I could buy it. I lost a house we loved because the person that we agreed to go under contract in couldn't close on their loan in time, and now my family's missed out on the house that we wanted because the sellers had to move on as well. It can be a nightmare. We get you fully approved so that all the hard work is done before you go out and even look at that house. And when you go out on Saturday, I encourage you to look at the house you want first. Don't do it regionally. If there's a house that's at the top of your list, go there. Go look at that house because there's 4 other people looking at that house. And if you spend 2 days looking at areas that you don't think you want, waiting to get to the house you love, it might not be there anymore. So you go out there on Saturday to the house that's at the top of your list, and you fall in love with this house. It's yours. You want it. There are 3 other families that are looking at that house that afternoon, and they're going to love it too. They put that offer in. Their piece of paper that they send the offer in says pre-qualification. This is not approval for a loan. Because you went to Movement Mortgage and you got fully approved, your letter says you're approved for a loan. You've got a commitment letter. When we call that listing agent, we call that seller and say, look, this client is done. They're approved. There's no chance this loan's falling through. You're going to get the house. You're going to get the house your family loves. You're going to get the house that you want to live in. And you might even get it for a better price because you called Movement Mortgage, because you called me. You called me at 843-300-7870. Or maybe you found me at my website, www.lowcountrylending.com. You can go on there. You can read comments from other people who I've done business with. You can put an application in for a buying power evaluation. It's all free. There is no cost to get fully approved. None at all. We're the ones devoting the time and money that it takes to do that. I worked at many other banks. No one else does it. No one else cares enough to take the time to put you in a better position to get the house that you want. So thank you so much for listening today. This is Bill Sandvig with Mortgage Matters. here on WTMA 1250, The Big Talker. If you have any questions for me, please reach out. 843-300-7870. Thank you so much. We'll see you next week.
You've been listening to Mortgage Matters with Bill Sandvig from Movement Mortgage. Call Bill for your mortgage needs at 843-300-7870. That's 843-300-7870. Listen again next week at this time for another edition of Mortgage Matters with Bill Sandvig on 1250 WTMA.